Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Globalstar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or sell. Globalstar is a satellite communications company that sells satellite phones which can get reception anywhere on Earth. It sells phones to people going to remote areas, such as people like me and you hiking or traveling to distant places, or traveling to places that don't get good phone service. Also, people in the military use these phones, employees that work off the grid, and many more people benefit from satellite phones. The company is headquartered in Covington, Louisiana, and was founded in 1991. It went public in 2006 and trades on the New York Stock Exchange. It is similar to Iridium Satellite Constellation and Orbcomm Satellite Systems. Both of those are publicly traded companies. The Globalstar second generation constellation consists of 24 low Earth orbiting satellites. These satellites are what is required for people to connect to others when using these types of phones. The goal of the company is to continue building market share and prove its phones are reliable in any location. It also sells phone chargers that use satellite technology, walkie-talkies, simplex and duplex satellite data modems. Simplex is one-way communication and duplex is two ways. It was originally launched in 1991 as a joint venture of Loral Corporation, that's a defense contractor, and Qualcomm, that's the giant billion-dollar semiconductor company. Let's get started with the model. This is a mid-cap company, 2.3 billion market cap. They're trading at $127 a share and they have 1.8 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow in 18 and 19, but they do have positive in 2020 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's only positive in 2019. Revenue is a sales for the company, and that's pretty steady. It does decline a little bit from 130 million to 123 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And then below that is operating expenses, and their operating expenses are higher than their gross profit, so they have negative operating income every year. Below that is the interest they pay in their debt, and they do pay a good amount of interest, from $40 to $60 million a year. Below that is other income and expenses, and these big positives in 2018 and 19 are the gain on the sale of security. When a company sells one of their assets, they may make money, so they have to book it to other income and expenses. Sometimes they lose money in the asset, so they have to book a negative to other income and expenses. So the reason they have positive net income in 2019 was this gain on the sale of the asset. I would focus on operating income when I look at the income statement, which is negative every year. But most of this is depreciation. Depreciation is a non-cash item. So you'll see on the statement of cash flows, they're actually generating positive operating cash flow, even though they have negative operating income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So it is good they're generating positive operating cash flow, because they spent so much money in capital expenditures in the past. They're passing through so much in depreciation expense onto the income statement. Depreciation brings down your net income, but it doesn't affect cash flow. And then you have capital expenditures, which are investments in property, plant, and equipment. They spend $7 to $10 million in CapEx the past few years. Operating cash flow minus CapEx gives you your free cash flow. And they did have positive free cash flow in 2020 for the first time. They also had positive in the trailing 12 months. And they have a ton of shares outstanding, so they must be issuing a lot of capital stock and diluting their shareholders. They issued 60 million in capital stock in 2018 and 4 million in 2019. Every time a company issues capital stock, it increases the shares outstanding, making your shares less valuable. They did issue 250 million of debt in 2019, but it looks like they issued that debt just to pay down the old debt. So it looks like overall they're trying to reduce the amount of debt they have on their balance sheet, which is good because they do have a decent amount of debt. Let's look at the capital structure. $436 million of equity, $400 million of debt. They're 52% equity, 48% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 6.75%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.5 billion. We divide that by 1.8 billion shares. And we get a calculated stock price of 86 cents. They're trading at 127, so they're trading at a 48% premium. It's a sell according to the model. Simply Wall Street is a little lower than me. They're at 75 cents, so they're also saying the stock is overvalued. This is the stock price since it started trading. So you can see it was about $15 a share when it IPO'd. And then in the first year, it kept coming down. And then since then, it looks like it's been trading in a pretty tight range. But it's really hard to tell on a chart that has 15 years of data. This is a stock price in the last year. So it looks like it was trading at about 35 cents for a while. And then in January, the stock was really driven up. One of the reasons the stock price was driven up because in January, Nokia entered into agreement with Tideworks. Tideworks uses Globalstar's Band 53 spectrum at the Port of Seattle. Also in January, Qualcomm said it's going to use the company's technology in its new 5G modem. Qualcomm is one of the founding companies of Globalstar, so it's good they have that relationship with them. Qualcomm can really help Globalstar grow as a company, but when the stock price goes way up, it's not like anything changed with the company. They didn't make more money. It's just the idea in the future they'll make more money. Of course, they may not make any money with these agreements. Maybe both companies part ways, or maybe they do work together, but Globalstar doesn't make any money or even loses money. I don't think it's that beneficial to buy a stock when these news stories come out. If you own the stock at this point because you like the company and you're bullish, and then a news story came out, that's great. Or if you do buy the stock during a run-up, as long as you hold the stock for a long time, that's okay. But if you buy it at any of these points, you're probably going to lose money because it usually comes back down. As you can see here, although it's trading at a higher price than it was before the run-up. And this stock has tripled in the past 52 weeks while the S&P 500 went up 36%. The 52-week low was 29 cents, the high was $3. So the stock has gone up 1,000% from its 52-week low to its 52-week high. And the stock is trading above its 50-day and 200-day moving average. This is a really liquid stock. 20 million shares are traded each day. Of the 1.8 billion shares outstanding, only 600 million are on float. When a share is on float, that means it's available for the public to purchase. The 1.1 billion of shares not on float are held by insiders and no one can purchase them. The best stocks for a short squeeze are stocks with a low float, like this one, and a high short percentage. Their short percentage isn't too high at 7%, so it wouldn't be a great candidate for a short squeeze. At least a short percentage above 20%. Only 17% of the shares are held by institutions. This stock has done really well in the past year and past 3 years, up a lot more than its industry and the market. But in the past 5 years, this stock and its industry have not done too well, while the market has gone up over 100%. In the past 5 years, their annual earnings decreased 11%. In the past year, their earnings decreased over 100%. Since most years they have negative earnings or sometimes a small profit, these numbers can be pretty volatile. But once they stabilize and get consistent positive earnings, these numbers should be more normalized, like up 19% like its industry. Although in the past year, the industry is up 125%. That's a pretty big jump, especially when the market is only up 21%. If you invested $10,000 into this company 10 years ago, you would have more than tripled your money at one point. But the stock came crashing down. It has come up since the bottom, and you would have been at a small profit. You would have been up $500 on your $10,000 investment, which is not great, but it's much better than being down. James Monroe is the biggest shareholder at 57%. He's the executive chairman of the board. He was also the CEO of the company from 2005 to 2009 and 2011 to 2018. He also has a lot of experience in this industry. He oversaw the operations of a lot of different types of companies. companies in power generation, natural gas and exploration, industrial equipment, real estate, and other types of industries. So he has a lot of experience, a great person to have on the team. And that's why they have such a low float, because of him. He owns 57% of the stock. That's locked away, no one else can buy it. Mudrick Capital is the next biggest shareholder at 5.5%, then Vanguard, Beck, Mack and Oliver, and Thermo Investments, and also James Monroe is the biggest shareholder in that company. Let's look at their financial ratios. The average PE is 33, the median in the market is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Their price to sales isn't so great at 18.4, much worse than the market median and average. The reason they have a weak price to sales is because they only have a little over $100 million of revenue, and their market cap is $2.3 billion. So you can see how much smaller their revenue is relative to their market cap. When a company has a high price to sales ratio like this, people invest in a company thinking they're going to grow their sales a lot in the future. That's the idea when you invest in a company with high price to sales ratio. When you invest in a company with a low price to sales ratio, you don't expect them to grow their sales that much. They do have a good price to book at 5.2, which is between the market median and average. And they have negative operating income, so they have negative return on invested capital, negative interest coverage ratio, and negative ROE. And they could almost cover their current liabilities with their current assets. Their current assets are only $8 million of cash, $28 million of receivables, and $47 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose. If you want to know what it's set aside for, you can usually look in the notes in the financial statements. So the company does seem to be well capitalized. They finally had positive free cash flow. It's $12 million in the trailing 12 months. They do have negative $2 million of working capital. So they have $9 million of funding. So it looks like they should be able to get through the next 12 months without adding any more debt or diluting their shareholders. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 12 companies in the same industry as Globalstar, and if Globalstar has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at the PE. They're worse than average in price to sales. They are better than average in price to book, so they have a good balance sheet. They're about average in current ratio. They have a negative ROE since they have negative earnings. And they're doing a little better in debt than the average. And they're the smallest company on this list at $2.3 billion market cap. So to summarize, I have them trading at a 48% premium. I think this company might have a really good future. There are a lot of people that really need satellite phones. It really makes people safer because if you're stuck somewhere with no cell phone towers around, no one may ever find you. And if they could make a niche for themselves or somehow separate themselves from their competitors, they can start growing a lot faster. And having that great relationship with Qualcomm can be a game changer for this company. If they can leverage that relationship, they may be able to grow a lot faster. I rank their free cash flows 3 out of 10, their revenue 5 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.